China's capital market has long been a paradise for financiers and a hell for investors. Even after a recent rally, Chinese indexes have only just returned to levels seen in the aftermath of a dramatic bubble burst a decade ago. A $10,000 investment in the S&P 500 index a decade ago would now have more than tripled in value, while the same amount in China's CSI 300 benchmark would have added just around $3,000. What is the reason behind it? Reason is structural, created 35 years ago as a way for state-owned enterprises to channel household savings into building roads, ports, and factories. Exchanges have lacked a strong focus on delivering returns to investors. That skew has spawned a host of problems, from an oversupply of shares to questionable post-listing practices, which continue to weigh on the $11 trillion market. State-owned companies primarily answer to the government rather than shareholders, while many private entrepreneurs have little regard for small investors. Its impact: many ordinary people come in thinking they could make money, but the majority of them end up poorer. Instead of incentivizing consumers to spend, poor equity returns have nudged them towards saving in a scenario when President Xi is counting on domestic spending to reach the 5% economic growth goal, especially as a tariff war with the US heats up over the massive trade imbalance. The limits of China's stock rally have again been evident this year. The CSI 300 index has risen less than 7% despite a burst of optimism over AI, trailing benchmarks in the US and Europe. Over the past year, China's top leadership has shown greater awareness of the stock market's importance as a vehicle for wealth creation. That's especially the case with an ongoing property slump and a fragmented social safety net, which exacerbates a sense of insecurity. The Communist Party's Politburo pledged to stabilize housing and stock markets in a December 2024 meeting, a rare expression of support for equities at the high-level gathering. The body also called for increasing the attractiveness and inclusiveness of domestic capital markets in July 2025. And much to be seen, but till now, reforms are not working.